Meanwhile, next week marks the final Fed meeting of 2024 and the last meeting before President-elect Donald Trump returns to office. For more on what to expect from the Fed, let's bring in FedWatch advisors Ben Emons. Ben, great to see you.
Good to see you, Bill. Good to be back.
Hawkish cut. What do you think? What are the odds?
Yeah, it looks like that's going to be the case, right? The market is very convinced that the Fed will cut rates. I think that was really to do with the data coming exactly in line. You know, when we talked about the last time on the show, I was sort of hinting like, I think this Fed is closer to a point where they're actually going to skip a meeting or maybe be on hold for a period of time because, let's face it, we do have an economy that stays really strong. And since they cut rates in September, all data has been basically lifted up. So inflation's risen, unemployment rate has not moved too much. So I think the Fed is at a point where it may cut, again, one time more rates, but then it could hold off. And it's an interesting dynamic going into January, right? Because the January meeting is right after the inauguration, is when the debt ceiling takes place. So it may be really between these two meetings that the Fed decides like to stay on hold for a period of time.
Ben, it's Karen. Thanks for being on. I sort of think they should do a dovish pause rather than a hawkish cut. Is there any difference between those two besides just a little window dressing?
Yeah, that's interesting to say it that way, Karen, because, you know, if you think dovish pause and it would be market friendly when you say hawkish cut, it's like, you know, you cut, but you actually are more hawkish than you would perceive to be, and that could be negative. So I think it's in the middle of the two. It's a bit tough to say. I guess that the Fed is sort of saying we can cut rates, but we're still in the phase where the economy is strong enough where we maybe be on hold for some time to assess the data, and you come then sort of down in the middle. I think for the market, it simply means that if they're going to cut rates, it probably will lift the market a bit into year end, because I do think that small caps and industrials and financials will rally on that. But on the other hand, if you're going to hold off from there, people are going to extrapolate that out into the first quarter of like rates are going to stay a little higher than anticipated. That will be probably the negative side to markets.
Hey, Ben, Tim, I noticed you flagged the dollar. I agree with that move. I also think the central bank differentials are starting to show up again, not just BOJ, which can't be hawkish even if they want to, but also what's going on in Europe and some weakness that we're seeing across the EU. What are the implications for the dollar, do you think, next year on either, you know, where it is actually going to be supportive to the Fed or, you know, talk about multinationals, talk about what that means for bond yields? What are your thoughts?
Typically, dollar, Tim, if it gets really strong, I mean, it's an uplift to the economy in terms of inflation because you get lower imported inflation on a strong dollar, and it will be a headwind for multinationals in that sense. That's been also the typical effect. With bond yields, I think if you think of a strong dollar, yes, if inflation gets more controlled by a strong dollar, it will probably be positive for bonds. I think going into next year, the anticipation is that the U.S. economy will continue to stay really strong, if not get stronger. And as you mentioned, like we have challenges in Europe, and we got the Bank of Japan sort of sitting here, like they may hike, but not so fast. So the dollar has a lot of room to rise. So I do think it will play out in the sense that maybe somewhat headwind for the multinationals, and ultimately keeping bond yields somewhat capped, but with a caveat there, though, that if you're going to keep cutting rates, you are stimulating the economy, right? So that makes the dollar stronger, but you also lift rates higher. So I think the dollar will strengthen, and the yields are still like poised to go higher ultimately.
Ben, I've long argued that, you know, the tight credit spreads are really what are leading this rally in equities, or are supportive of this rally in equities. You mentioned the spread between the 2-year and corporate bond spreads. Would you mind elaborating on that a little bit and kind of speaking to some of the risks that might be elucidating?
Yeah, but I think like, you know, these corporate bond spreads are not as tight as we've been since the financial crisis. And if you look at this graph, like it seems to be that the history, you know, it may not repeat, but it does rhyme in the idea, right? Because ultimately spreads do widen significantly when the Fed has to cut rates really sharply because we're in a downturn. So we don't seem to be at that point just yet. But one point is to make here is that if the Fed were to keep cutting rates, you know, and I say they do continue because they want to keep the unemployment rate like at this level where we are now, and not letting the situation worsen. You know, a worsening labor market is ultimately going to erode the economy and therefore widen spreads. So I do think we're at this point where spreads will probably stay tight. It's a leading indicator to the broader equity market. But there's some scope here for ultimate widening if you are going to cut faster. So as we were talking earlier, it seems the Fed wants to get potentially on hold for a period of time to see how things play out. But spreads are indeed really, really tight. So it does mean that the economy ultimately is going to drive spreads wider. And that's the big question for next year. It doesn't seem clear right now, but it does seem that spreads are really at the low end of the range.